Dollars rise amid uncertainty, markets await U.S. inflation data and trade tensions. The U.S. dollar experienced a slight increase on Thursday, driven by cautious market sentiment ahead of the long-awaited release of U.S. consumer price inflation data. This data, delayed by a prolonged government shutdown now on its 23rd day, is set to be published on Friday and could significantly influence expectations for the Federal Reserve's next policy decision. Simultaneously, renewed trade disputes between Washington and Beijing have cast a shadow over market confidence. The Trump administration's consideration of export restrictions on a wide range of software-driven technologies, including laptops and jet engines, in response to China's recent rare earth export curbs, has introduced fresh uncertainty into global markets. This development has heightened concerns among investors, who are already grappling with the information vacuum caused by the government shutdown. The significance of the dollar's movement. The dollar's movement reflects investors' growing unease as they navigate an information vacuum due to the government shutdown and shifting geopolitical dynamics. With limited official data releases, traders are eagerly awaiting the upcoming CPI report as a crucial indicator of the Fed's policy trajectory. Market expectations overwhelmingly indicate that the central bank will cut rates next week and again in December, highlighting a global shift towards monetary easing. The escalating U.S China trade tensions pose a threat to global supply chains at a time when inflationary pressures are beginning to subside in major economies. However, the relatively subdued response in safe haven assets like gold, the yen, and the Swiss franc suggests that traders perceive the tariff threats as strategic posturing rather than an imminent economic crisis. The Federal Reserve's dilemma. The Federal Reserve finds itself at the center of market attention, with traders pricing in a 97% chance of a quarter-point rate cut at the October 29 meeting. The Treasury Department's delayed data releases, a consequence of the political stalemate in Washington, have further complicated the Fed's decision-making process. Japan, on the other hand, faces a delicate balancing act. The yen fell to a one-week low against the dollar as markets awaited details of a major stimulus package from the new Prime Minister Sanai Takaichi, who is widely expected to favor aggressive fiscal and monetary easing. The Bank of Japan, set to meet on October 30, is not anticipated to raise rates until at least December. Britain's inflationary challenge. In Britain, persistent inflation at 3.8% has kept sterling under pressure, intensifying speculation that the Bank of England might cut rates by the end of the year. Central banks across Asia and Europe are closely monitoring the situation, aware that another Fed rate cut could trigger significant ripples in global currency and bond markets. The road ahead. With traders largely in a holding pattern, Friday's U.S. CPI release will play a pivotal role in setting the tone for global markets in the coming weeks. A softer reading would reinforce expectations of consecutive Fed rate cuts, further weakening Treasury yields and bolstering equity markets. Conversely, an unexpectedly strong inflation print could complicate the Fed's easing path and introduce short-term volatility into forex markets. In Japan, Prime Minister Takaichi's upcoming stimulus plan, expected to surpass last year's $92 billion package, may offer temporary support for domestic consumption but could also exert further downward pressure on the yen. For now, global markets appear to be in a state of anticipation, caught between the limited flow of economic data and the unpredictable trade brinkmanship between the world's two largest economies. The outcome of these developments remains uncertain, leaving investors and traders in a state of cautious expectation.